bad. Just take.
Hey, we're live. You're good. We're talking some technical issues. There's some latency going on. So Stacy's going to do her best today here on Real Estate Now. Stacy, it's the last Thursday in May. Are you ready?
I'm ready. I apologize to everyone watching us. If you can't hear me, Keith's just going to tour and I'll come on from my view. But I did want to talk about our. Am I okay?
Yeah, you're good. You're good.
Okay. Did want to share our views last week, because as you know, we like to donate to food banks. Last week's views were 300. So thank you much for you guys' support. Keith and I really appreciate it. And we will be donating that amount of money to our local food banks. Back to you, absolutely. Keith.
So keep sharing, keep liking, keep engaging. Super excited to jump in today's topic. It's one of hurdles that first-time home buyers have, move-up buyers have, is getting into the next house, down payments, and we're going to talk about utilizing a tool, mortgage insurance. And in a lot of circles, mortgage insurance has a negative connotation. In this circle, it's got a real positive, empowering connotation. But before we bring our guest speaker here today, Tammy Golden with Arch MI, we got to do what we always do on the weekly. We're going to go look at what rates are doing. Mortgage rate, the mortgage rate survey provided by Freddie Mac, one of the two GSEs. Mortgage rates are still ticking back down. So it is not too late to jump in and secure those refinances. Great time to buy a house. Money is dirty, dirty cheap. So take that affordability, turn it into a housing payment, start getting the appreciation and paying down that equity. Huge time to do it. So that 30-year, Stacy, what do you think? Over, under, that 30-year going to get below 3%? What do you think? Where are we going?
I'm going to say under.
Under.
I don't know when. It could be in 12 months, but it's going to hit it. Might be for 20 minutes.
Throw a dart at a calendar and see where it sticks. And we'll go with that date.
Okay.
So right on.
Well, I'm going to call October. How about that?
October. Okay. October. May 28th, 10:03, Stacy Chevalier calls October for the 30-year under 3%. So we will revisit that in October and we'll see if that prediction came true. But in the meantime, we're going to talk to you guys about taking advantage of an amazing mortgage tool, mortgage insurance. And to help us go through this discussion today, I want to join the conversation with Tammy Golden. Tammy, welcome.
Hi, Keith. Hi. Thanks for having me today.
Absolutely. I'm glad that you could join us because mortgage insurance is quite a mixed topic out there, would you say?
Agree. I don't know that it's necessarily mixed as much as it is just misunderstood.
Oh, good clarification. Yeah. Absolutely.
Yeah.
So Tammy, tell us, you're with a mortgage insurance company. Tell us your background really quick.
So I represent Arch Mortgage Insurance. There's 6 mortgage insurance companies nationwide. Arch is just one of them. And so I work here in the Northwest and work heavily with Loan Depot. I'm happy to be doing so. And this is, I don't know, I think I've been in MI probably 8 or 9 years now and in the industry for over 20. So different aspects of the industry, but definitely in the mortgage insurance space for quite a while now.
Awesome. Yeah. Awesome. Yes. So you said it's misunderstood. Mortgage insurance, let's just start with the basic foundation of what is mortgage insurance.
Yeah, so the mortgage insurance, kind of in a nutshell for the average consumer, is a product that protects the investor in the event that the borrower defaults on the loan. So if the client's unable to make the payments, it protects the investor's investment, essentially, to give that client all that money. Does that make sense?
Yeah, absolutely. And I always like to tell.
It's hard to kind of think of just because it's not a consumer-based product. The consumer doesn't have any control over it, and I get that. And it's very hard sometimes to digest, but know that it's not a consumer-based product, but it is required for all loans being sold to Fannie and Freddie that the mortgage insurance be on there for loans over 80%. loan to value. So if you buy a home with less than 20% down, your loan is required to carry mortgage insurance if it's being represented, but it's not a special product.
Right.
Yes.
Yeah.
And I think the thing that confuses maybe even originators is when a consumer's putting, say, down 18%, they can get a better rate than if they're putting down, say, 21%.
Correct.
And so I get that question from out, like, what's going on, Stacey? And I'm like, well, the mortgage is risky, even though the consumer's putting less money down.
So the servicer is exposed, or the individual who's lending the money has less exposure because the mortgage insurance company is reducing that amount of exposure by a certain percentage based on that loan to value. So therefore, it is a less risky product. So in the event that the borrower were to default on the loan, that servicer is not exposed to that entire loan balance, but has a level of protection there. And that in turn gives the consumer a better price. So the difference between an 80% and 85% loan obviously has a pricing difference, and it's a little bit lower by going with a higher LTV, right? Or less down, as a client would see it.
Yeah.
I mean, I guess to answer your question, Keith, what is mortgage insurance? I hope we covered that. But ultimately, mortgage insurance increases the client's buying power. So think about trying to save 20% down. So if you wanted to put, say you had $20,000, you first-time home buyer or even a move-up buyer has $20,000. 20% down would get you a $100,000 home.
Right.
Not a whole lot. Or it could give you 10% down on a $200,000 home, or I think it's 5% down on a $400,000 loan. So if your income then qualifies, if you meet all the other requirements, you would have the ability with the same amount, the same $20,000 to either buy a $100,000 home or a $400,000 home. So obviously mortgage insurance makes home ownership possible and increases the client's buy power at the end of the day.
So important. And I mean, once upon a time, banks wouldn't go past 80% loan to value.
Right. Correct. That is true.
So,
and it's not also kind of in the what is MI category. It's not to be confused with the mortgage insurance that's provided through FHA. That is separate. That is different. PMI stands for private mortgage insurance. So this is a private entity. FHA has their own mortgage insurance that operates and functions and is priced completely separately than what we do. So what it's not, this is not the mortgage insurance. I think some people who are not familiar is like, does it pay off my mortgage in the event that I pass away? No, this is not what mortgage insurance is. So I want to demystify any of that as well.
Hashtag not a life insurance policy.
Correct. So hopefully that answers your question.
Yeah, it did. I mean, I think the increasing the buying power, that mentality is a really good one. From the flip side, it's still the number one hurdle for first-time home buyers is that down. And per the title of what I put there on Facebook and YouTube out there, like your dad is giving you bad advice to sit around and wait until you have that 20%, because I mean, it takes people a long time, especially up here in Seattle, the greater Seattle area. Our median listing price is $774,000 now.
Right. Like I said, it makes home ownership possible. Without it,
Yeah. So that opportunity getting, I mean, how is the affordability on mortgage insurance? A lot of folks have this preconceived notion that mortgage insurance is so outlandishly expensive. What are you?
So there's been some changes. There used to be kind of a set price that everybody followed. Arch actually was a bit of an industry leader in coming up with more of a risk-based pricing, which all mortgage insurance companies follow. While we don't all have the same price and the same analytics behind our pricing, we all operate now on a risk-based pricing model. Think of it this way. I have now a 16-year-old that just started driving. So when you think about auto or healthcare insurance, that 16-year-old driver, right, a little bit gray hair there, that 16-year-old driver is a costly individual because he is at more of a risk. And I understand that. So we pay more for that. So kind of think about that in the same way that you think about mortgage insurance. Those clients who have a little bit more of a more risky portfolio, if you will, or more risky attributes to their loan, maybe a lower FICO, trying to buy at the maximum of their ability, that takes on just a bit of a different risk factor. So we price to that risk, as opposed to, your grandma in our grocery getter has obviously a lower premium. Same goes, those 80 to 85% loans might be priced a little bit better with clients that have the higher FICO scores. So while there's no set pricing, just know that the risk-based model is out there. And I believe all the mortgage insurance companies follow that.
Is it
Yes,
possible to give
agree.
the viewers like a range of what the risk may be from
Yeah,
85%?
Stacey. Well, there's not necessarily a range. I mean, I think our system, RateStar, which is our risk-based pricing engine, issues 1 point some million, maybe it's more than that, different mortgage insurance premiums. So it's hard to pinpoint. However, I will say there are different risk attributes that are more favorable. For HMI, 2 borrower loans priced better than 1. While you may not have 2 wage earners in the home, you have the potential for 2 income earners. So think about that. There's different pricing depending on where the property is located. Your debt to income ratio is another factor. So there's different factors that can go into making that pricing, if you will, more accurate.
Is a condo and a single family resident same, or are they different as well?
Priced the same here at Arch. So
awesome.
And that's important to know, that mortgage insurance is available on condominiums, your manufactured homes, up to 4 units, investment properties. While the maximum amount that you can borrow and the minimum FICO score that you need might vary a little bit on those products, know that that's available. So mortgage insurance is not just for the single family residents. It's, it's available for more than just that.
Gotcha. I wanted to circle back to Stacey's question. I actually did this morning, Tammy. I went to your guys' website and priced out a purchase of $750,000. And I did 5% down, 10% down, 15% down, and then the monthly mortgage insurance costs associated with those. I love having this conversation with folks because there's always opportunity costs in doing stuff, right? Whether you want to wait till you have 20% or you want to jump into it. And I look at appreciation. In Seattle, we appreciate historically at a 5.2% annual appreciation rate. And so there's an opportunity cost of waiting. And so this graph is just showing 2 things. Number one, how affordable it is to get into mortgage insurance with a 5% down payment on a $750,000 house. That's $37,000 out of your pocket for a down payment. And yet you have to pay the premium of $403, but on the flip side, you get the appreciation. And I think this is one thing that's so missing in the consumer public's knowledge and wheelhouse today, that, mortgage insurance is truly your friend to get out there and take advantage of real estate.
I couldn't agree more. And this example is on a monthly mortgage insurance premium, but I think it's worth noting as well the different mortgage insurance options that are out there. Definitely there's the monthly premium that this example shows very clearly. There's also single premium mortgage insurance sometimes, and that's in a 1 lump sum. So just one, and that can be any combination of borrower, seller, or lender contributions paid at closing. Just 1 lump sum paid at closing, then you don't have mortgage insurance. You don't have the monthly premium. So when you think about that, if there's seller contributions where a client's purchasing a home and they're willing to kick back some money, or if the lender has a little bit extra, I think about Stacey's comment on the 80 versus 85%, and the rates. Say we get to 3%, and an 80% loan pays 1, but an 85% pays 1.5. That difference, that half-point difference, could that be paid as part of your single premium, and then your borrower doesn't have mortgage insurance, and that's just paid at closing and you're done with it? There's also lender-paid mortgage insurance. Sometimes people call that a no MI option. That's where the mortgage insurance is built into the rate. So instead of 3, you may be at 3.25 or 3.5, and then that mortgage insurance is paid out on the back end, and the client doesn't deal with it at all. But it does have a little bit of a higher interest rate. So there's different ways to be a little bit creative. It's not always just monthly mortgage insurance. So don't freak out when you hear mortgage insurance, and don't freak out over the monthly mortgage insurance premium as well. There's options out there when it comes to MI.
Yeah, and I want to circle back to that. So just so everyone's super clear, when you talk about getting rid of this monthly mortgage insurance, it's just a one lump sum payment at the closing table. When you close and sign at the escrow table, you're going to pay one lump sum, and you don't have the 400 or the 286 or the 148. Right. It's just one and done.
Correct.
Right. That's huge, because that also increases their buying power, right? Because then they can take this money that they're putting in mortgage insurance and put that towards their loan amount.
Right.
Can one of you also speak towards split MI?
Sure. So great question, Stacy. So split mortgage insurance is a combination of that single premium, that one lump sum paid at closing, and a reduced monthly mortgage insurance premium. So you pay a little bit up front, and then instead of maybe the $400, you're down $300 or $200, depending on your loan to value. So that's kind of how that works. Arch does not offer a split mortgage insurance premium. I know some of the other MI companies do. It is out there. It's available. We have a little bit of a different product that Loan Depot's in the process of approving and rolling out. So we'll talk about that on the next time I'm on your show. How's that? Because it's really exciting.
No, yeah, that's great. I'm excited. You guys will have that, and you do bring up a good point. We love working with you, but sometimes we do have to look at other companies, and there are other companies that have little niches, and so it's important to find a lender that knows how to find the right MI product for your situation, because stated there's a few companies out there, and sometimes you have to all of them at different times.
Right. Yes.
So we touched a little bit about mortgage insurance and first-time home buyers, and Fannie and Freddie have some first-time home buyer programs that allow you for a discounted mortgage insurance rate. Is that correct?
Correct. So Home Ready, Home Possible, those are some great products that allow maybe, unlike FHA, allow for a little bit higher LTVs. There's a few niches in there that, with Keith and Stacy as your experts on the lending side of things, can give the clients the specifics on. I think those products are amazing, and they offer not only some little gems in there, things like roommate income being calculated in, or an ADU on the Home Ready. It also offers a lower monthly mortgage insurance premium on specific products should they apply. So there's a few little caveats that are in there, but definitely those are an option as well. So those products specifically really make home ownership possible. The ability to have gift funds, Arch allows you to have a bunch of gift funds in there as well. So lots of advantages for the first-time home buyer, definitely.
Gotcha. So the consumer doesn't go to your guys' website like they would their hazard insurance. I get this question a lot.
Yeah, the consumer doesn't shop for the mortgage insurance. That's why they have you guys. You two are the experts, and everybody at Loan Depot knows how to get a hold of an Arch MI account manager in their respective locations. But ultimately, like Stacy said, you guys know where some different little nuances are with different mortgage insurance companies, and can go out and price accordingly. But ultimately, it's up to the lender to place the mortgage insurance.
Gotcha. So with the current COVID situation that we're in, has that changed the access or your guys' analytics? Has that changed your guys' business at all?
Yeah, great question. Definitely. There is, obviously, when we first talked about what mortgage insurance is, it's the borrower's, protects the investor in the event that the borrower were to default on the loan. So the ability to repay obviously is a question with the unemployment numbers that came out earlier this morning. That's definitely of concern. Are people going to be able to pay their mortgage? I will say that Arch completely supports the CARES Act and the forbearance piece moving forward. But I think it's important that everyone know that we align 100% with Fannie and Freddie and their temporary guideline changes. That's definitely important to know. So whatever they're doing, HMI is supporting that as well. Are there some things we're looking at? Absolutely. You know, we have to make sure that client still has a job at the closing table. And I'm sure you want the same thing as well.
Yes, yep.
The ability to generate income. Are there different markets that we're looking at? Absolutely. Some different parts of the country are being hit a little bit harder. Those that are heavy on the travel and tourism, you know, got to take a look at that. And that goes back to that risk-based pricing as well. Are we going to see some pricing changes throughout the MI companies? Absolutely.
Wow.
So in those cases where there is higher risk, are you seeing that you can't get the MI, or is it a higher price?
It's not that you can't get it. It's just at a different premium potentially, depending on the scenario.
So coming full circle, you guys are rating the risk accordingly based on the geographic location then, I would assume.
Yep. Geography is definitely a contribute, like an attribute to our pricing. Yes.
How are we doing up here in the Pacific Northwest?
Great question. Not too bad, actually. There's definitely other places in the country that have seen some more adverse pricing. Not gonna lie, that's probably doesn't come as a big surprise though. So
really quick, we're getting close to our 30-minute time limit.
Okay.
But we've been talking a lot about purchase. Mortgage insurance just isn't on a purchase, correct?
Correct. Absolutely. You can refi as well. And again, maybe you know, are doing something a little bit creative. This kind of just reminds me of cancellation. So maybe you're doing a purchase or, yeah, I want to make sure we touch on that for your client.
Thank you.
I know. I'm out of that. So no, definitely on a refinance, say the appraisal goes out and it doesn't come in quite where you wanted it to, and you find yourself that you thought you were at that 80% mark and you were going to get rid of mortgage insurance, but in fact, I'm with you. But in fact, you ended up still needing the MI, and that's okay. It's available on the refinance as well. So that brings me to my next piece, which is cancellation. Can your mortgage insurance be canceled? I get this all the time. There are some new changes. First of all, keep in mind when we talked about FHA, anything 90% and above, loan to value on FHA, that mortgage insurance is on there for the life of the loan. So kind of keep that in mind for those higher loan to value pieces. But on private MI can you get rid of it? Yes, there are a couple of nuances when it comes to that. Original value. So you purchased your home. There's some changes most recently where the seasoning period of that is no longer the same as it once was. And I think that's a misnomer amongst both the general public and loan officers alike. So there's no longer that 12 to 24 month waiting period. So for an example, a client wants to purchase a home and they haven't sold their primary residence, the one they're living in. So they're wanting to go buy another home. They've got the down payment. They qualify for both residences. 2 months later, their house sells. Maybe they're moving cross country or whatever their scenario is. And they want to take that lump sum and now buy down, pay down the loan amount and hopefully exclude the mortgage insurance, get rid of MI, right? That's absolutely possible now because we're going to go off of the original value. The one piece I want to make sure everybody knows is that it is ultimately up to the servicer whether or not you can, get rid of the MI. So it's worth consulting with your servicer on that. So make sure that's done. Current value. So say you have a home and you've done a bunch of improvements and you're like, hey, I put in this new kitchen. I've put in a great backyard. I think I now have the ability to refinance and go off of my new current value and get rid of mortgage insurance. There is still that 12 to 24 month period from the servicer. So again, double check with them. But just know that it's a little bit easier nowadays for clients to remove MI based on original value, not current value. So there's some pluses there.
Is there any benchmark through the life of the loan that the MI will go off if you don't have.
Under the Homeowners Protection Act, at 78%, the mortgage insurance will automatically be removed.
Of the original loan dynamic.
Correct.
Right. Gotcha. And
So
I bring that up.
Schedule on that and see when that is based on your loan.
Yeah, I'm totally leading you on that question because that is, I pull up the amortization table of all my clients and say, hey, this is your 78% benchmark. You only have to pay MI until we get here.
Right.
And it's a real powerful tool for folks to know that they have that peace of mind that in 4, 6, 7, 8 years, they're going to be out of the MI. It's awesome. So what else do we need to know about MI as we start winding this down, Tammy?
I would say a couple of things. If your clients are interested in going down that road of home ready or home possible, there are some homebuyer education courses that need to be taken in order to get your client qualified for that. Your MI companies, Arch specifically, does indeed offer that. That's on our website. There used to be a $75 fee associated with one of those programs, but I think it was Freddie Mac's. It's now being waived, so don't worry about the fee on that. So you can come to Arch for your client's first-time homebuyer education. That's available.
That's great.
Yes. Tax deductibility. So mortgage insurance has been approved as a tax deductible piece for 2018, 2019, and 2020. So work with your tax advisor on getting the details on that. I know there are some income thresholds on there. So there's some possibility though that you can have a tax income break for your MI. And for Stacy and Keith and anyone else at Loan Depot, we also have a toolkit on our website. It's called the Roadmap to Home Ownership, and it provides you with so many details of how to put on a first-time homebuyer class, any pamphlets that you need, the information, the glossary, the terms, and then you could be your own MI expert. But really help your client understand kind of that roadmap to home ownership with mortgage insurance in place.
So that's for industry professionals?
Correct.
Awesome.
That's a great reason.
Could you do me a favor there in the private chat or after this? Can you send me the link to the home ownership class?
Yeah.
Because
we'll put it in .com, but I'll definitely send it out to you so that you can link it with this information as well.
Yeah, we'll put it in the footnotes here as well, because that's a great resource. And like you said, anybody that number one, it's a great resource for anybody that wants to buy a house, whether you're going to use Home Ready or Home Possible, but it's required for those two programs, but it's an awesome opportunity that you guys are offering that to clients.
So I think bottom line is don't fear the MI. It truly makes the home ownership possible, and you can live the American dream of having your own home.
I would just like to also add, like, even if you have the 20%, and maybe Keith, you touched on this earlier, but it may make sense if you talk to your financial advisor to not put all that money down and use that money elsewhere. And so you got to do this cost analysis if it makes sense. But so this is not just to help you buy a home, but it's even if you have the money, you should definitely look at all your options and see what makes the most sense.
That's a great point, Stacy. I mean, maybe you put less money down and you're able to invest that money someplace else to make it work for you for the long term, depending on your client's scenario. Maybe there are some home repairs that need to be done, or maybe you want to furnish that home, that new home, or whatever the information, whatever the scenario is for your client. Absolutely.
Yeah, and we're getting some Facebook love for you, Tammy. Thank you so much. So, and that's a great point.
Thank you for having me today. Thank you for working with ArchMI. I know our whole company absolutely appreciates the relationship. So thank you so very much.
Yeah, absolutely. And stand by after the broadcast, but we'll catch up with you a little later. And
follow-up information.
Awesome. Thank you. I appreciate it.
Okay, thanks.
Catch you on the next go around. So Stacy, just wanted to conclude here. We got like 40 seconds before we're out. Yep. What do we have coming up next week?
Oh, you're putting me on the spot.
I'm putting you on the spot because it's going to be awesome for all of our business owners and realtor friends and entrepreneur types that are trying to make it through this COVID time.
Okay, I don't want to I'm trying to get to my calendar. I didn't know we were doing this. Hang on.
Renee is awesome.
Oh, I don't even have it, but there's a whole blurb on him. But a good. I don't want to introduce him poorly, but I'm going to. But we have Renee Rodriguez on next week. He's an industry professional. It's going to be a great, definitely a great show. Keith, do you want to add to that since I'm totally unprepared for this?
Yes. So Renee is going to be joining us. We're going to be talking about mindset and how we're all in this current situation with COVID-19, working through our businesses, whether you're self-employed, you're an individual consultant, finding that mindset to have action and get through this. Super important right now as we're starting to re-engage our economy. We're starting to re-gear and find the new normal. Coming out of phase 1, coming into phase 2, what does that look like? So please join us next week for a mindset, how to build a real estate portfolio. What are these actionable items to get ready and get set for success? So hope you all can join us next Thursday at 10 a.m. on Real Estate Now. And until next week, Stacy, we'll see you next week.
Yep. Thanks, everyone. Take care.
Thank you.